The Hedgeless Horseman here. I thought I'd make another video. It appears that there's, you know, still a lot of people that are having a hard time right now. Since I don't know, today, for example, metals are down, oil down, most things are down, I think, and I mean, most people are, and we can't really help it. We're very short-term focused. Uh, Main reason is because everyone else is short-term focused. So it's like, I mean, personally, I think it's uh, prob well, for most people, I think it's net negative to be on Twitter, etc., too much, and especially looking at the portfolio and individual stocks, etc., because we all get wrapped up in this short-term thinking. Because again, everyone else is doing it, and since everyone else is doing it, and moreover, most people are traders, so it's like you get bombarded by short-term focus, short-term opinions, short-term feelings due to the volatility, and a lot of opinions from traders. I mean, there's almost in every correction, there's always people uh, who, let's say, try to caution you. I mean, this latest dip was no different. When I, kept on saying, well, I'm buying here, easy buys, no-brainer buys, from a value long-term perspective, because it's like, in my opinion, it's like these are, some of the most no-brainer buying periods I've ever seen. It's like, what are the odds that I'll if I hold long enough, what are the odds that I'll actually lose on most of these juniors? I think they are very low, incredibly low, probably lowest they've ever been. But then there's always some people who, just have to put their opinion in that, hey, I think they can go lower. I think that. Yeah, pretty much that the juniors can go lower. It's like, again, that there's no stock that can't go lower, but obviously that's short-term thinking. Okay, so I'm supposed to not buy something that is selling for maybe 20-30% of what it's worth just right now, and probably 10% of what it might be worth in 2 years, because it can get even cheaper. I mean, that's how also most people think about risk, that the stock price can go down. That's risk. Like, okay, I'm not comfortable buying because I think the stock price can go lower. If you're buying cheap, how is that really a problem? That just means that you can buy even cheaper if that comes to pass. And like, for juniors, they are the most sentiment driven vehicles you can invest in. I mean, just look at this chart I put up. I mean, they tend to lag pretty much the majors. And look at this 2016 rally here. Uh, okay, it's like, yeah, it went up here, got dragged up here, let's say. But at the end of this move, I mean, Newmont jumped from here to there, but strategic metals, for example, jumped from here all the way up there. So late in the, leg up, let's say. And here, for example, I mean, Newmont bottomed here already in this time period. Strategic metals didn't bottom until, much later. I mean, this is like October to May. So that's a lot of pain and frustration you see here. Because I don't have the gold price on here, but like, okay, Newmont already started to trend up for a few months. And if you were in juniors, you probably were looking at a multi-month downtrend after, a like 2 year downtrend. So it's like, how many people can stomach being, not selling out here? That it's only long-term value investors that are gonna buy these bottoms. And what happened later? Okay, then then it finally turned around, rocketed up, and then lo and behold, more frustration because Newmont kept on going up. This was around the flash crash. I think this was actually the flash crash. But you see, strategic metals went down to the same bottom. So I mean, again, if this was frustrating, imagine like, okay, yeah, now I'm up, and if you're a hodler, let's say, so you're keeping your position, and then it rolls over again and goes back to the exact same point, pretty much the exact same point as 2016. I mean, if I don't know, there's not many people that are left here, and testament to that, I think that I mean, lately at 37 cents for strategic metals here, all their 120 projects and 11 royalties came for free if you bought the company. So I mean, that's just irrationally cheap. Obviously, that speaks to just how few actually are willing to buy. That everything is almost given away in the company. So there's like a lot of value, very low risk, but that isn't enough to get people to buy. And that's of course what you're after. I mean, the lowest risk possible with high probability of returns. So it's like, what are the odds that someone who bought strategic metals, if you get 120 projects for free and 11 royalties for free, is going to lose money if they hold long enough? Those odds are incredibly low. And worst case scenario, you just have to wait for it to reach, let's say, this level. So that's you can have a strategy if you have low amounts of capital. I mean, you could just trade strategic metals pretty much. Just buy every time it goes to the green zone and sell every time it hits this. But it comes with a lot of frustration, a lot of patience, etc. So most people won't do it. I mean, if you just did that in strategic metals, you'd probably beat 95% of people's return in the junior sector. So it's like, it's never, in my opinion, again, it's like we are our worst enemies, because it's pretty obvious how you can have a profitable strategy in a lot of these juniors, just playing the sentiment, not really even being right on a particular company's catalyst or anything. You can just trade the sentiment. I mean, personally, for me, I like to do both: play the sentiment and pick the stocks that have the best future ahead of themselves, let's say. But just to point out again, you see this divergence. Newmont goes up, strategic metals goes down, and then rocket boosters come into play on strategic metals, and juniors, again, late. And here you have the same thing. I mean, at this point in time, okay, strategic metals hit this level, Newmont hit that. At this point in time, Newmont was all the way up here, and strategic metals had put in a lower high. But then rocket boosters. So when Newmont just traded sideways, strategic metals went on a tear. So okay, again, just remember, we're very backloaded in juniors, and they get more punished than all the rest. So it's like, don't be the person that sits through all of this and then sells in this green area, for example, and miss these rocket booster rides. It's like, sell at least after the rocket booster the revaluation has come, and that's what we're seeing right now. We're seeing a divergence, miners to majors. So majors, Newmont put in a new high, an all-time high pretty much. Strategic metals is not anywhere close to being at an all-time high, not even multi-year highs. So this is a big gap between juniors and majors. And even though majors can come down now, etc. That doesn't necessarily stop juniors from going up. So that's what I, again, it's like the risks in juniors are so much to the upside. Here, for example, you have Newmont peaking after a nice trend, starts to head lower. Again, strategic metals, I mean, most people would say sell juniors because, okay, majors are going down. But that didn't stop strategic metals from all of a sudden revaluing. And again, here you have, I mean, I wouldn't say this was probably not much of a gap actually, but it just get very excited in the junior space. And this was an epic rally. Uh, just know that sentiment is low, and when we get to sentiment highs, we're gonna reach these levels, and we're gonna go higher than that. This just basically the same short, but it's like, okay, let's go through some stuff that I think is very, very helpful right now to keep yourself sane. Because again, it's like if you look at Twitter, if you look in forums, most people, I would say way above 90% of people, 95% of people are short-term oriented, etc. And everyone is trying to guess what a stock is going to do tomorrow or next week. There's no edge in that. And it's always going to look like if a stock goes higher, you're going to project it going higher tomorrow and next week. If it goes lower, you're going to project it to go lower and lower next week. So if you have that mentality, you're always going to buy high and sell low, because you're going to be scared that it's going lower when it has gone lower, and you're going to be afraid that it's going to run away from you when it's going higher. So it's like, okay, first of all, goal visualization. Okay, my goal visualization is that we're at a sentiment low. Okay, so from a psychological or sentiment perspective, we're gonna hit this level, let's say in strategic metals within 2 years. Okay, I know that. I know that. You're gonna have to take that to the bank, that you know you're gonna hit this level. That helps with like buying low, because you know that this is inevitable. It's an inevitable rise. I mean, of course, it's not inevitable for a particular company, but we're at a sentiment low. This signals it's a sentiment low. For many years, it works buying down here and just waiting for it to hit that. And if you look at the valuations, they confirm it. These are stupid cheap prices, which means that the market is irrational, it's irrationally fearful, and it's irrationally cheap. So okay, you have that going for you. Jumping around here. Goal visualization, conviction that be greedy today when something goes lower, because you know that it's going to hit X in sometime in the next 2 years. That's, delayed gratification basically. The lower something goes, I mean, the juniors are probably going to go down today because metals are down. I'm not buying because I'm not greedy because I think they're going to go up tomorrow. I'm greedy because if they're going up here and I can buy it down here, that's even better. And that doesn't, if it goes down the next day as well, that doesn't take away the fact that the purchase here is going to, go up here in return, let's say 100%. What it means is that if I have dry powder tomorrow as well, let's say, I'm probably going to get 110% on that purchase. So this was not a mistake. It's a mistake if you buy here and it, knowing it will go here, instinctively knowing, but get fearful and sell here. So you take let's say a 5% loss and then go play in another sector, whatever, where the expected returns are way worse. That's a mistake. A mistake is never selling low. I mean, you could have bought all of these bottoms here and you would still be sitting at 100% when it reached this level. And even if that took 2 years, that's crushing the market. I mean, most people will never have those returns. So this buying something that goes down is not a mistake. Buying something that should go up and will go up is a mistake. So I'm, you can look like an idiot for large periods of time, but if you just keep that in mind, that you have this visualization that it's gonna hit this level, you obviously would get increasingly bullish the lower it goes. Where people, I mean, the ones that are selling down here, they're selling partial ownership of their companies. Not because it's, I mean, there's nobody that can make a case that strategic metals, for example, is expensive down here, that you're overpaying for something, that it's gonna stay at this level, should stay at this level, and should not go up. No. People who sell down here, they're selling because they can't take it anymore. They don't care about the valuation. They don't care about sentiment. They are the sentiment. They are the market. So the ones that are selling down here because they think it's forever gonna go lower, they're the ones buying here because they think it's gonna forever go higher. So the ones that are selling down here or at these levels are the ones that don't care about valuation, and they will be the one that overpay for the stock you bought down here up here because they don't care about valuation. They look at the trend. But again, just keep in mind that if you pick your, whatever junior, and just, visualize that in 2 years this is going to be up 200%. If it's trading at 50 cents, goes down to 46 cents today, let's say, but you know that it's going to $1.5 within 2 years. That should get you greedy instead of fearful. And that obviously, visualization brings conviction that the market is stupid. I mean, when I see all the time people, and that's always traders, like the market is always right. I mean, in what context is the market always right? How is the market right down here? I mean, this has 100%, has shown 100% success ratio, let's say, of getting 100% returns. So no, I think for a value investor, you should never assume that the market is always right. You should assume that the market is always emotional, and you should assume. I think I mean, just playing that fact is a lot better than always thinking that the market is always right. Because if that's the case, why are you even trying to pick stocks? That makes no sense. Because you're saying that the market is always right, so there's no opportunity really. And if that was right, I wouldn't have the returns I have. So, and again, it's like, take like daily tactics. Okay, if you have 30 juniors, I'm up to, I don't know, 40, 50 perhaps. I don't even keep count anymore. If you have a bunch of companies, a bunch of juniors, and you know that they're gonna go up 200% on average, and you know that this is gonna do a mean reversion, so that's your goal visualization. You know that on a short to medium time frame, juniors are going to go up 200%. From a strategic long-term perspective, they're going to go up 500 to 1000%. Okay, that's your goal visualization. That's what will should keep you in the game and buying low, because obviously you buy more of a finite asset the cheaper it gets. So I mean, down here, the amount of projects, etc., you get for your dollar invested is increasingly high. So that's why I think you should be an asset hoarder right now. It's like, okay, how much stuff does this company have? If it goes down, that just means that every dollar invested buys you personally get more, bigger percentage of that, all of that stuff. And don't forget that, which is easy to forget again, because most people are traders and short-term oriented. You're not, when you buy companies, you're not directly invested in gold or silver. So it's like, yes, gold or silver can go up or down, but that's like, of course you would want to see a positive trend for your metals. And I mean, the you can't get a better, let's say, mean reversion prospects than this. And this is Discovery's over time. So it's like, and look at the macro picture. So if you're in gold, it's like this is the best macro, tailwinds you probably will ever see for gold. So it's like the case for gold is solid. I mean that's you can take that to the bank pretty much. That's the, in my opinion, for the most superior uh, commodity case right now. Well, perhaps silver is even better because it's so undervalued. But again, that's like if you have that in mind, okay, the macro picture for gold, silver, solid, probably never been better. Okay, that's like why I am full bore into this sector since 2015, because the final payday will come when the system changes. We have a system reset, and until we've hit that point, I assume that gold is in a bull market, because recently when gold made this correction over, what is it, 18 months or whatever, a lot of people were calling it for this is a rerun of 2011 top, it's going to go lower, yada yada. I just assume that until the system resets and we have a revaluation of gold, the gold bull is on. So that's my that keeps me in the game, knowing that okay, the case hasn't played out yet, not by a long shot. And if you look at this, that also tells you that we're far away from the time when it's like probably not a good idea to own real assets and commodities, or not that it's a bad idea, but the returns in other stuff is probably way higher. So we're not even close to that. So that's like okay, that's a no-brainer. I expect to be in gold, for the next couple of years, several years perhaps. And the miners, again, from a just short to medium term sentiment perspective, no-brainers. From a valuation standpoint, no-brainers, which typically, of course, coincides with emotional sentiment lows. So again, the big edge is time horizon. So if people are selling because they fear, let's say they sell something that is incredibly undervalued because they fear it will go down in price tomorrow. So what's the big edge there? Obviously, if someone, I mean, all the way down here, someone is gonna sell down here because they fear it will go down there, and people are gonna sell here because they fear it's gonna go down all the way here. And people sold, I mean, someone sold down here because I don't know what they're expecting, or it probably was perhaps a margin call or whatever. But it's like that's so irrationally cheap. And if you have a longer time horizon, if you buy here, here, with the simple, let's say, simple realization that within a year or two, I'm going to be sitting at least 100% returns. That's a big edge. So the person that's selling all the way down here and sells out at the bottom, you would buy more here obviously because the returns would be even better. So I mean that also means that, I mean, one tactic I like to use, or an easy tactic, is let's say gold is down 2%. Some miners are down 5%, some are unchanged, some is down 10, some is down 15. And again, you're not investing in the actual metals, you're investing in companies. And you see no news out of these companies. So, I mean, what does it matter for a good company? Nothing has changed. The employees go to work every day, in order to create value. So, yes, gold is down on March 15, 2022. The company gets 15% cheaper. So, did all the future prospects of the company go down 15% just because gold fell on a Tuesday by 2%? Obviously not. But that's how the market works. So again, it's like if you, I mean, there are a bunch of companies where I have a visualization of where I think or what I think they're going to do over the next 12 to 24 months. That's what keeps me buying and greedy. So if I see a company that I think will have exceptional news releases over the next 12 months at a sentiment bottom, and it goes down 15% from an already cheap level. That's like the biggest no-brainer. Again, you just have to know that they are gonna go up. They're gonna go up a lot. The best thing you can do is buy as low as humanly possible. And it's like, take these are the kind of companies I prefer. The growth stocks, for example. I mean, strategic metals is incredibly cheap, and you can make a living just trading the sentiment swings. But the growth stocks, you get more kind of paid to wait here, because the tops and bottoms tends to be higher up. Even though, I mean, this is a sentiment low, sentiment low, sentiment low, but they're higher, and the tops are higher, top here, top here, top here, and then buyout. But I mean, you hear people making 20 bag returns on Great Bear, but almost nobody can actually sit through this. Can just hold on for dear life. I mean, these are extended periods of frustrating movements. It's like, this is easy, obviously, but then you have a fat correction, and then it doesn't even come back to the same high, and then down again. So a lot of people are going to be selling out at the exact bottom. But if you just looked at the signals, like, okay, let's say down here, what do I think? What has a Great Bear proven or proved up until now, and what do I think Great Bear is going to have proven up or proved up within the next 1 to 2 years? How are the news releases going to go? And then you think, okay, I think 10-20 news releases over the coming 12 to 24 months, and they're going to be net positive. I think they will have expanded the Dixie project by 100%. So, okay, if you're at this point and you're like, okay, well, I think it already should be valued here, and I think that in 2 years they're going to have proved up value in the order of this level here. Of course you're going to be buying. You're going to get greedy. You're going to be wiring money as fast as you can. But the people who are selling here, they're just selling because I think it's going to go lower tomorrow. So that's the big edge. See, like Eric Sprott says, see the future early. Visualize the future. So right now, again, I visualize a future where sentiment will get to a high again. That's going to be good for 100% in stocks like, boring stocks like strategic metals. I think it's going to be good for 200% in more exciting juniors. Then you visualize, even longer term, you visualize this mean reversion. That's going to, take a few years probably. And then if it's a growth company, pretty much any explorer, let's say, you're going to have to visualize the coming news releases as well. So if I think, okay, sentiment is going to reach a high one day, that's good. Let's say within the next 12 to 24 months, okay, that's going to bank me 100%. But the company is also growing, and I expect there to be net positive news releases over the next 12 to 24 months, okay? So if it's undervalued now because of sentiment, etc., I think it's gonna, let's say, double or go up 200% on sentiment alone. But on top of that, I think it's gonna have grown 50% over the next 12 to 24 months. So let's say you double that. So now I'm expecting, around 400% returns in some of these juniors over the next 12 to 24 months. How can you not get greedy in that case? Because all fear comes from short-term thinking, and all greed comes from short-term thinking for the most part. But long-term thinking, for a good company, that's where the greed really kicks in. Because again, short-term, yes, you're going to be greedy here, and I'm guilty of that as well. And of course, you're going to get fearful down here. But it's just you have to block out that irrational noise that things always change. And I mean, imagine this period in Great Bear. I mean, what is this? Like, 447 days of downtrend. most people are willing to sell down here, and most people will miss this. Most people are willing to sell down here and miss this. Don't be the don't be the person that sits through all this shit in a declining sentiment trend, sells out around these bottoms, and then miss all the upside. So it's like the market is not rational on a daily basis. Nothing happened to your junior today if they go down because price is down. Who knows? Maybe your favorite junior is out in the field right now and made a outcropping discovery, and that's going to be released next week. You have no idea. You just know that regardless of what gold and silver does, the companies are doing the work they're doing. They show up to work because they're not, they don't sleep in just because gold or silver is down. Maybe they'll work even harder. So if you have a good management team, etc., and a good project, there's constantly value creation happening behind the scenes. Let's just look at, a list here of some companies. It's like visualization. Okay. Forget about the sentiment for a while here. What's gonna happen? Like Nevada King. Okay, they're gonna be back drilling Atlanta gold mine. They've upped the budget to 13,000 meters. Okay, I foresee that over the next 12 to 24 months we're gonna have much more very thick high grade assays out of Nevada King. We're gonna have assays from Lewis. We're gonna have assays from Iron Point, Novo Resources. They're gonna be putting out more news probably than most juniors, and all of these I would say are cheap right now. You're not paying for where they are today, and you're not paying for any future potential. It's like Nevada King. I hit that Iron Point isn't priced in. I think it's cheap based on Atlanta alone. So okay, that's in my opinion risk-free upside. Not that the price might not take a hit if they only drill dusters. It's just that if it takes a hit, it's gonna come back. That's what risk-free upside is, in my opinion. Novo Resources, you're not paying for almost anything there. So if they make some kind of discovery across their, 20 targets or whatever, I'm not paying for that. It's just, wait and see. Irving Resources, they're just drilling. I think they're gonna have more high-grade hits. Newfound Gold, one of the more, easy ones. They have 14 drill rigs drilling at, I don't know, 4 or 5 targets along 2 10-kilometer trends. If you give these guys 12 to 24 months with 14 drill rigs, where do you think, assuming that the mineralization just doesn't disappear on every target, what do you think the company is going to look like in 12 to 24 months? Do you think it will be more valuable or less valuable? Cabral Gold, I think they're up to 5 rigs. And they hit stuff all over the place. I mean, this is not rocket science. On a 12 to 24 month period of time, I think all of these companies here have a big shot of being at least 50% more valuable. And if they're starting from an undervaluation of 50%, the risk reward is so favorable, the odds are in your favor, that it's again unreal not to be bullish. And it's like that probably is the same for your favorite juniors. So it's like you don't need to buy the companies I like. I just think that obviously, just based on strategic metals, juniors is the sector that will have some of the highest future returns out of any sectors, just because they're so cheap. And just to come back to important to keep yourself sane. Goal visualization. Know that sentiment is gonna hit a high one day. No, try to visualize what you think your specific junior is going to have done over the next 12 to 24 months, and stop looking at the daily movements and think that the market is right. I mean, if someone sells a high quality company 10% cheaper today just because, let's say, gold is down 1.5%. Oh my, it's like, it doesn't get better than that. So if I'm not sure what I'm actually gonna buy, because everything looks good to me right now, almost everything. I mean, there's like 40 companies I'm happy to add in if I had dry powder. The single best and simplest tactic you can have is pretty much buy whatever is down the most on any given day. Because if you have a bunch of companies that will have short somewhere, a mix between this and this, and they don't move in they don't correlate exactly. So then you'd be buying simply the ones that are the cheapest on any given day. It's like, okay, let's say here, for example, I mean, assuming these are identical companies, okay, then you'll buy Newmont this day because it lower than Strategic Metals, and here you'll be buying Strategic Metals over Newmont, and here you'll be buying a lot of Strategic Metals over Newmont. So that's just playing the piano pretty much. Buy whatever that's the cheapest, because that I know that has worked out very well for me. And you don't need to do more thinking than that. Just have the conviction to know that if your junior is down, if one of your juniors is down 20% on no news and one is down 2% on no news, maybe the rational thing would be that the one that's down 2%, maybe you kinda can buy that, even though they won't actually have a project in production in the next 10 years. So what gold does today is pretty much as as meaningless as for the company that's down 20%. But you can't justify a junior going down 20% just because gold is down one day. That just doesn't happen. So I mean, it's just, these are incredible bargains we're seeing right now. You're stealing incredible amounts of future supply in a time where future supply is getting increasingly rare. So yeah, just again, it's like, don't pay attention. Everybody's most people on Twitter, etc., in forums, short-term thinkers. They're many people who ask me about a stock, they're asking, is the bottom in? What do you think it's gonna do next week or next month? It's like, I have no idea. I just know that, like always happens, if I buy something cheap, it turns out well on average. I mean, stuff can happen for a particular company, but just buying cheap is enough. And don't allow yourself to try and guess where the price is gonna be tomorrow or next week. If you just change that aspect of your investing strategy to instead buy, just allow yourself to think, what do I think this company is going to be worth in a year or in 2 years? And only consider that. That's going to, lower your anxiety. It's going to make you greedier when things are cheap. It's going to make you less greedy when things are expensive, because, okay, if a company has gone up, X hundred of percent, it's like, okay, now it's getting increasingly hard for the company to create enough value to actually not only fill the price it's at right now, but to also surpass it. So, yeah, basically final, or I think the most important thing, don't allow yourself to be stuck guessing where share price is going to be tomorrow or next week or next month. Visualize where you think the company's value is today and where it's going to be in the next 12 to 24 months. and always have a rolling time horizon like that, because almost nobody has that. So what that means, of course, is people who are selling down here don't, or aren't even aware, because they don't think about it, what the company will be. It's probably a better example, Great Bear. The ones that are selling down here are not even factoring in, not even thinking about what the company might be have created in the next 1 or 2 or 3 or 4 years. So that's where your edge is. Buy cheap from the people who don't even consider the signal. They consider the noise and they look at the trend. So you will have these wild durations all the way. But if you just think about the value creation trend and where you think it's going to be in the next, 12 to 24 months, that alone should make you greedy enough. I hope you got something out of this, because I'm probably gonna, apparently need to ramp up this thing again, videos, etc., because it's fascinating. I mean, at the recent bottom in juniors, around this period of time, there was a lot of hand holding, a lot of people saying they can go lower, they can go lower, and as soon as juniors are up like 30% or 40 or 50%, these people go away. But sure enough, they'll be back if we go down 10-20% from here, and say it can go lower. So they're always going to be missing these entire moves, and they're going to be buying in when it's quote safe, and that's going to be around the tops. So it's like, it's not my business. My business is not, my job is not to guess where a company is going to trade tomorrow or next week, or where gold is going to trade, or the sector overall is going to trade tomorrow, next week. I am a stock picker. I pick companies where I think the value creation curve is somewhere along here, but I also pick companies that are so beaten down that just from sentiment standpoint, when we hit the next sentiment peak, they're going to be up 200-300%. Obviously, again, the best combo is obviously to buy at low sentiment, where you get the revaluation from sentiment alone, and you have a growth curve. That's when you can get these kind of results. And obviously, if you had that strategy, you would be buying every low more than you would buy every high. So actually, you would have even better returns than the trend here, because you would be heavily buying when it was below trend line, and the returns would be like that instead. But if you do like most people, they buy here when the returns are kind of muted, and instead when it goes down to this area, when the returns are very high again, they sell out, because they can stomach this downtrend. So it's like, if you just bought every bottom in Great Bear, you would actually beat this trend here. But if you bought high all the time, you would obviously have a more muted return than the dip buyers. Thanks for listening, and I'm biased, so every company I mentioned, just assume I'm sponsored and own them. I don't remember which companies I talked about, but yeah, thanks for listening.